Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
After listening to today's news, you'll know first Starwood Capital CEO calls the AI boom a bubble, warning its $20 billion data center business is threatened by OpenAI's shaky financials. Today, we'll take a closer look at this financial contradiction and its implications for the sustainability of the AI infrastructure boom. Second, a new US bill reclassifies Bitcoin and Ether as commodities, shifting power from the SEC to the more industry-friendly CFTC. So we'll discuss why this matters and what it means for institutional capital and the creation of a crypto car system. Third, Foxconn's 17% profit surge reveals a pivot from iPhones to building high-margin AI servers for Nvidia. We'll explore how this pivot transforms Foxconn into a high-value systems architect for the AI and electric vehicle industries. Fourth, Google uses the RICO Act to sue a syndicate that allegedly stole 115 million credit cards using a phishing as a service platform. We'll break down this legal move and what it signals for tech giants adopting aggressive private law enforcement roles. Fifth, Sony breaks the 5-year console cycle, delaying the PS6 as soaring costs make live service games on existing hardware more profitable. We'll examine how this shift impacts future console roadmaps and the core economics of the entire gaming industry. A billionaire real estate titan just said the quiet part out loud about AI, and it's an absolute bombshell. We've been saying for a while this AI trade is a double-edged sword today. One of the actual builders just said it himself. Barry Sternlicht, the CEO of Starwood Capital Group, just went on the record. His words, I think we have to let people go, right? Jobs of 15 people can be done with a chatbot that cost me $36 a month. He didn't stop there, calling the speed of AI's impact terrifying. And he's not just talking hypothetically. Continuing our last discussion about the $1 trillion replacement thesis, this is where it gets real for a lot of people. Research shows that the roles most vulnerable inside a company like his are positions like junior analysts, paralegals, accountants, and marketing coordinators. Why? Because their work is data intensive and often follows a routine. What's often overlooked is that AI tools can now perform tasks like contract reviews or financial risk assessments in seconds, work that used to take a team of people hours or even days. One study even suggests that within a decade, technology could replace up to 90% of the tasks currently handled by real estate professionals. Now, if you think he's just an outsider criticizing the tech world, you're wrong. A few days ago, we talked about the race to build national AI factories. And remember the IEA's warning that data center electricity demand could roughly double by 2030. That raises the bar for what it takes to earn a real return. This is where the situation takes a more complex turn. Sternlicht's own firm has a staggering $20 billion dedicated to the data center space, the very backbone of the AI revolution. And you have to understand, these aren't just regular buildings. We're talking about massive, power-hungry warehouses filled with the servers that are the physical foundation for the cloud and for AI. He's building the future he says he's terrified of, but the plot thickens. Even as he pours billions in, he's sounding the alarm on the entire enterprise. He's openly questioning the creditworthiness of his own potential tenants, specifically naming Oracle and its deals tied to ChatGPT. He bluntly calls ChatGPT a startup that doesn't make money and requires hundreds of billions of dollars to grow. We previously warned about the AI capital expenditure black hole, really high spending with payback, periods that aren't being made public, and Sternlicht is pointing directly at that gap. The implication is clear. A giant investor is worried the AI boom is being built on shaky financial ground. And it gets even more concerning. Brendan Wallace, a venture capitalist and Sternlicht's own partner, describes the web of commitments between the big tech companies and infrastructure providers as Byzantine and somewhat incestuous, making it nearly impossible to trace who is actually going to pay for all of this. We've talked about that opacity before, massive interlocking promises that make it hard to see who ultimately foots the bill. So let's break down what that incestuous label actually means. Let me map out the credit chain we walked through a while back, now with names attached. At the bottom, you have real estate investors like Starwood who finance and build the data centers. In the middle, you have a hyperscale cloud provider like Oracle who leases that massive facility. But at the top, you have the AI startup OpenAI, who is Oracle's customer. OpenAI has a deal with Oracle worth a reported $30 billion to use their cloud services, which requires Oracle to build an almost unbelievable 4.5 gigawatts of new data center capacity. We've also noted that OpenAI has talked up big revenue run rates, but as Sternlicht stresses, profitability and capital intensity are the sticking points. The core risk is that if the startup at the top, the one that, as Sternlicht points out, isn't making money yet, can't pay its bills, the whole chain could collapse. A default could cascade down from the AI app to the cloud provider and finally to the real estate investors who own the physical buildings. This all leads to one jaw-dropping calculation. Wallace did the math on what it would take for all the planned AI data centers to actually turn a profit. His conclusion is a showstopper. He fears the revenue needed would be the equivalent of 120% of US GDP. Now, is that number an exaggeration? Maybe. But even the more conservative independent estimates are staggering. One analysis from McKinsey projects that by 2030, the world will have spent over $5 trillion just on AI-optimized data centers. We previously said investor fatigue with AI hype was setting in and valuations were vulnerable. The moment sentiment shifts, this math is why. And while we've contrasted today's AI cycle with the dot-com era, real technology, cash-rich backers, and less systemic risk than 2008, that doesn't protect overbuilt infrastructure from painful write-downs if cash flows don't show up fast enough. So the update today isn't just another warning from the sidelines. It's confirmation from inside the build-out. The spending spree we flagged as a potential black hole is colliding with credit risk, soaring power needs, and uncertain payback. The very architects of the AI infrastructure boom are now openly questioning if it's an unsustainable bubble propped up by a startup that doesn't yet make money. From the financial jitters in the AI infrastructure world, we're shifting to another high-stakes arena, facing a massive regulatory overhaul, cryptocurrency. A power struggle is erupting in Washington over its future, and a new bipartisan bill is set to hand enormous power over digital assets to one agency, potentially sidelining the regulator that has dominated the space for years. This isn't just a bureaucratic shuffle, it's the culmination of a long-standing philosophical war between two powerful regulators, the SEC and the CFTC. The SEC, or Securities and Exchange Commission, regulates investments like stocks and bonds. The CFTC, the Commodity Futures Trading Commission, oversees commodities like oil, gold, and wheat. For years, they've been in a turf war over who gets to police the world of crypto. Here's the core of the shakeup. The draft legislation officially reclassifies the two titans of crypto, Bitcoin and Ether, as digital commodities. This single change yanks them directly into the territory of the Commodity Futures Trading Commission, or CFTC. For years, the SEC has been the primary enforcer in crypto, but this move dramatically shifts the balance of power. The implications of this reclassification are huge. The SEC has historically used something called the Howey test to determine if a digital asset is a security, which comes with very strict rules. This has led to many enforcement actions against crypto firms. The crypto industry has long argued this approach stifles innovation and has pushed for CFTC oversight, which they see as more flexible and better suited for this new technology. By defining Bitcoin and Ether as commodities, this bill is essentially siding with the industry's view. The financial implications are staggering. One analyst at Bitwise predicts this will create a starkly bifurcated market. This effectively creates a kind of crypto caste system. For regulated tokens like Bitcoin, it's expected to trigger a massive influx of institutional capital, deep liquidity, and a robust derivatives market. This provides the legal certainty that compliance departments at major financial firms have been waiting for to finally make strategic allocations. But what about the thousands of other tokens, the so-called altcoins? They could be left in a regulatory grey zone under the SEC's stricter rules. This could lead to mass delistings from exchanges and push innovation into the shadows as companies become afraid of breaking the rules. But the real shockwave is for crypto companies themselves. The bill takes direct aim at the all-in-one business model common to crypto exchanges, where the exchange, broker, and proprietary trading desk all operate as a single entity. The new rules would require these firms to separate their businesses, forcing them to operate like traditional financial companies. This is what some are calling the tradfi-ification of crypto. In traditional finance, you have separate companies for the stock exchange. the brokerage that takes your order, and the market makers. This is done to prevent conflicts of interest. Forcing this structure onto crypto exchanges is a massive operational and financial challenge. It will increase their costs and complexity, but it might also be the key to unlocking institutional trust, as big money managers are used to this separated structure. This represents a foundational challenge to the very structure of the industry. While the bill is still a draft, its direction is clear. This isn't just another regulation. It's described by the Digital Chamber CEO as the most consequential roadmap for how institutions will integrate digital assets. However, the bill leaves one giant territory uncharted: decentralized finance, or DEFI. These are platforms that operate without any central company or intermediary, using code to run financial services. The question nobody can answer yet is, who do you regulate when there's no one in charge? This is the next frontier of the regulatory battle. This legislation is the critical step towards solidifying the foundation of the crypto industry in the US, unlocking its value for mainstream investors and consumers. Speaking of major industry shifts, another tech giant is making a huge pivot that's paying off big time. Get this, the company that builds your iPhone just reported a massive 17% jump in profit, smashing expectations. But the real story isn't about phones. This explosive growth is being driven by a massive pivot into artificial intelligence. Foxconn, the world's largest electronics manufacturer, is now a key partner to the AI chip giant Nvidia, building the powerful server racks that fuel the AI boom. The company's cloud and networking segment is seeing strong growth, and it's a direct result of this strategic shift. From a global perspective, this is a brilliant strategic hedge. Foxconn is a Taiwanese company with massive operations in mainland China, manufacturing for top US tech firms. This pivot into high-value AI servers moves them into a sector that's less politically sensitive than consumer electronics, buffering against escalating US-China tech tensions. But the rabbit hole goes deeper. According to one senior analyst, this isn't just a side project. Foxconn is making a calculated move, describing it as a follow-the-cash strategy that involves sacrificing some consumer electronics orders to secure a dominant position in the AI hardware market. The analyst added that this high-stakes pivot is clearly paying off. And when they say sacrificing consumer electronics orders, they're talking about their biggest partner, Apple. Now, get this, the profit margins on high-end AI servers are significantly higher than on assembling iPhones. Foxconn is betting that this high-margin AI business will be more valuable in the long run. Of course, Apple sees this coming and is already diversifying its own supply chain, moving more production into countries like India and Vietnam to reduce its dependency on any single partner. This all begs the question, what's the real end game here? It's a full-scale reinvention. Foxconn isn't just stopping at servers. The company is now also partnering with Nvidia, Stellantis, and Uber to build level 4 autonomous vehicles that don't require a safety driver. Think of it as a self-driving supergroup, an anti-Tesla alliance designed to compete. Each company plays a critical role. Stellantis provides the vehicle platforms, Nvidia supplies the AI brains and software, Uber offers the global ride-hailing network for deployment, and Foxconn brings its expertise in electronics and system integration to put it all together. It's a collaborative approach, completely different from the vertically integrated model where companies like Tesla or Waymo try to do everything in-house. On top of that, it recently signed a deal with Mitsubishi Electric to jointly supply energy-efficient AI data center solutions globally. This partnership also hints at the massive hidden cost of the AI boom, power consumption. To put that in perspective, a single high-performance AI server like Nvidia's DGX H100 can draw over 10 kilowatts of power. That's about the same as 10 household window air conditioners running at once. This partnership isn't just marketing, it's a critical engineering solution. Mitsubishi provides advanced cooling technologies needed to stop these data centers from literally melting down, making the entire AI revolution sustainable. For years, Foxconn's identity has been tied to Apple and the consumer electronics cycle. Now, it's making a deliberate choice to trade parts of its old business for a piece of the future. What we're witnessing is Foxconn's real-time evolution from a simple contract assembler to a high-value systems architect. For decades, their job was to build what other companies designed. Now, by co-designing server racks and creating electric vehicle platforms, they are moving up the value chain, capturing more profit and control. It's a journey we've seen before with manufacturing giants like Samsung, and it shows Foxconn is building the R&D muscle to compete at the highest level. The message is clear. Foxconn is no longer just the company that builds your phone. It's aggressively repositioning itself as a foundational player, building the infrastructure for the entire AI revolution. While companies like Foxconn are building the infrastructure of the future, our next story is a stark reminder of the dark side of that same global connectivity. A cybercrime group may have stolen up to 115 million credit cards in the United States alone. That's the bombshell number at the center of a massive new lawsuit filed by Google. The target is a group some researchers call the Smishing Triad, a cybercriminal organization largely based out of China. Google is accusing them of running a global SMS phishing operation that has victimized over 1 million people across 120 countries. Here's how they did it. The group allegedly used a phishing as a service kit called Lighthouse to create and deploy attacks. And this isn't just a piece of software, it's a full-blown criminal enterprise. The Lighthouse platform operates on a subscription model for as little as $88 for a weekly subscription, or up to about $1,600 for a full year. Any aspiring criminal with minimal technical skill gets access to the tools. We're talking over 600 different phishing templates that can impersonate more than 400 organizations in 74 countries. It's a turnkey solution for crime. This software allowed them to build fake websites that perfectly mimic trusted brands, including the US Postal Service, E-ZPass, and even Google itself. Victims would receive fraudulent texts about fake delivery updates or unpaid fees, directing them to these sites to steal sensitive financial information. But the situation takes a more complex turn. This wasn't just a scattered group of hackers. According to Google's general counsel, the organization was highly structured. Around 2,500 members coordinated on a public Telegram channel. There was a data broker group to supply lists of potential victims, a spammer group to blast out the texts, and a theft group to coordinate the attacks using the stolen credentials. And when we talk about this organization, the reality is far more disturbing than just a group of hackers. In fact, many large-scale scam operations like this are linked to a horrific underworld of human trafficking. Research from groups like Amnesty International has exposed so-called scam compounds in places like Myanmar and Cambodia. People are lured with fake job offers, then trapped, tortured, and forced to run these digital scams against their will. It's a modern form of slavery fueling this cybercrime. Now, Google is taking unprecedented action. They've filed a lawsuit under the Racketeer Influenced and Corrupt Organizations Act, or RICO Act, a law typically used to prosecute organized crime. Using the RICO Act is a very specific, very powerful legal strategy. Essentially, it treats this cybercrime syndicate like the mafia. This isn't the first time we've seen this either. Microsoft's Digital Crimes Unit has been using civil lawsuits for years to take down botnets by seizing their server domains. What we're seeing is a major trend. Tech giants are stepping into a role that looks a lot like private global law enforcement, using the courts to actively hunt down criminal networks. The goal is not just to block the messages, but to completely dismantle the Lighthouse platform and the entire criminal enterprise behind it. This move marks a dramatic escalation in the fight against digital fraud. It's a direct legal assault by a tech titan against a global, highly organized cybercrime syndicate, shifting the battle from simply protecting users to actively dismantling the very infrastructure of the attackers. This raises a critical question though. How effective can a US lawsuit actually be against a group based in China? The truth is, enforcing a US civil judgment in China is incredibly difficult because there's no formal treaty between the two countries. So while the lawsuit is a powerful tool, its primary purpose might be less about collecting damages and more about raising public awareness, disrupting the group's operations, and pressuring lawmakers to create stronger international frameworks to fight these transnational crimes. From one tech giant's aggressive legal strategy, let's turn to another's major pivot in business strategy, this time in the world of gaming. The story begins with a decision that caught everyone by surprise. The PlayStation 5 just celebrated its 5th anniversary, and Sony's official word on a new PS6 is, there isn't one. The 5-year console cycle that has defined gaming for decades is officially being broken. Believe it or not, the cost to create a truly next-generation leap in power is exploding. The economics of diminishing returns are kicking in. To give you an idea, the new 3nm computer chips needed for a hypothetical PS6 are incredibly expensive. Research shows a single wafer of these chips costs around $20,000, which is a 25% price hike over the tech used in the PS5. So Sony would have to spend billions just on the basic components, all for a graphical jump that might not even be that obvious to the average player. The cost to innovate is starting to outweigh the consumer's willingness to upgrade. According to PlayStation's business boss, Eric Lempel, the company is just going to continue with PS5 because the console is, in his words, really hitting its stride now. This is a machine that has already sold over 84 million units worldwide. But here's the bombshell. Lempel went on the record with a major tease, claiming the PS5's biggest selling game hasn't even been released yet. But that's not the whole picture. The real driver for this massive shift is a tectonic change in how games are made. One industry expert dropped a stunning fact. During the PS3 generation, legendary developer Naughty Dog, the studio behind The Last of Us, released 4 games. During the PS4 generation, that dropped to 3. And so far, during the entire PS5 generation, they haven't released a single one. This isn't just Naughty Dog. It's an industry-wide development bottleneck. Creating these massive AAA games now requires teams of over 1,000 people, budgets soaring between $200 and $500 million, and development times stretching 5 to 7 years, sometimes even longer. The financial risk is so immense that if one of these games fails, it can cripple a studio. This immense pressure has led to devastating consequences, with an estimated 45,000 jobs lost in the gaming industry between 2022 and mid-2025 alone. This slowdown is happening across the industry, with even Grand Theft Auto 6 now delayed to November 2026. While Sony is outselling Microsoft's Xbox, a different rival is proving the hunger for new hardware is still there. The Nintendo Switch 2, which released in June 2025, reportedly sold a staggering 10 million units in its first few months alone. Sony's answer appears to be accessories, like the PlayStation Portal, which lets you stream from the console you already own. Interestingly enough, Sony seems to be ignoring a multi-billion-dollar market. The success of the original Nintendo Switch, which has sold over 150 million consoles, proves people want powerful, dedicated handheld gaming. Even the PC-based Steam Deck has sold around 4 million units. In that context, releasing a streaming-only accessory like the Portal, which can't play games on its own, looks like a huge strategic miss. This all points to a new reality. The days of a new console every 5 years are over. The future of gaming may not be about buying the next new box, but about playing blockbuster games on existing hardware, as titles like Fortnite and Call of Duty prove that staying power, not novelty, is what now dominates the charts. And the bottom line is, this shift is incredibly profitable for companies like Sony. The rise of these live service games has completely changed the business model. Instead of making money by selling you a new box, they make money by keeping you playing on the box you already own. PlayStation 5 users, for example, are spending a staggering 176% more on add-on content and in-game purchases than PS4 users did. The money's no longer in the console, it's in the ecosystem.
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.